Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday the 24th of November 2016 and we're looking at central bank purchases of gold, its trends and what it means for precious metal buyers. We are all aware of the statement, "Don't listen to what they say, just watch what they do." Or, "Never mind the rhetoric, watch the action." Well, this certainly applies to the central bank's purchases of gold. Those of you who have been involved in our channel know that we generally base our gold and silver price assessments on fundamentals long term and political or economic results short term. Generally we get it right, but of course no one has a 100% record, and the post-Trump victory reaction, though we were on the money for the first 24 to 36 hours, the situation then reversed as dealers began to think, hold on, Trump is going to stimulate the economy. This is good for stock markets, and therefore bad for gold and silver. Very quickly though, appreciating this new reality, we predicted that again short term, gold prices were going to fall below $1,200, certainly before the second week in December. And yes, yesterday they closed some $15 below that figure and currently rest at $1,185 an ounce. Now, when we mention gold, generally the same applies to silver. It's rare for them to move in opposing directions, though it does happen sometimes. So when gold goes up in price, so does silver and vice versa. It's just generally the percentages that differ, depending upon what has caused the price movement. Coming back to the topic of this video, one of the keys or statistics we look at is the action of central banks. Generally, there is no greater insider than the nation's central bank. What actions they take is of considerable longer-term importance than many other metrics, not least with regards to their gold purchases. So when we see gold prices fall, and investors who hold gold fear that perhaps they've made the wrong decision in holding it, they should pay attention to the fact that those central banks that hold gold are not selling it. Before the collapse of Lehman Brothers, central banks had been net sellers of gold. However, a central bank gold agreement between the European Central Bank and 20 other central banks had been set up stating that the signing central banks do not have any plans to sell significant amounts of gold. As a whole, the per year limit is set at 400 tons. This agreement has been signed 4 times since 2000. Between 2000 and 2007, the central banks sold the amount agreed upon. Since 2008, this amount has substantially declined. For example, between September 2014 and September 2015, these central banks sold less than 3 tons of gold. On the other side of the coin, we also have to look at their gold purchases. In 2012, gold buying from central banks rose 17% year over year to 534.6 tons. As the price of gold fell in 2013, central banks hoarded an additional 409.4 tons. By the end of 2013, central banks held approximately 30,500 tons of gold, or around 1/5 of all the gold ever mined. This again increased in 2014, as central banks around the world purchased 584.9 tons of gold. In 2015, their reserves increased by another 566.7 tons, and up until the first half of this year, that trend continued. In the first quarter of 2016, they bought 108.2 tonnes of gold. In the second quarter, they added another 76.9 tonnes. Now, we must be mindful that such purchases are quite small compared to the debt issued by many of the countries these central banks belong to. However, what it tells us is that despite the anti-gold rhetoric of the Fed and others, in practice, these banks believe that it is important to hold some of their reserves in gold. In other words, they are hedging the value of their currency and supporting to some degree the level of their debt. So as they have been buying, it suggests to us that either they believe gold was cheap, or that their debt levels were increasing and needed to be supported, or that their currencies could come under a threat of devaluation, or a mixture of all three. From this, we can conclude that regardless of what happens to the gold price short term, holding a certain percentage of our portfolio in gold is the sensible thing to do. The World Gold Council has recently reported that in the third quarter of 2016, quote, central bank net purchases fell 56% year on year to 81.7 tonnes from 168 tonnes. Year to date, central banks have purchased 271.1 tonnes, lagging the 407.7 tonnes for the same period in 2015. Nonetheless, gold remains a significant and gradually rising part of total central bank reserves, currently accounting for more than 13%, unquote. Now, whilst we are confident from our analysis that gold and silver prices have further to fall, it makes sense to utilize any such reduction in price as an opportunity to top up any deficit you may have in your portfolio. This does not mean fill the cart or fill your boots, but just take a measured approach. Please try and remember that you are buying for the long term. Otherwise, you may as well join the other speculators and trade the paper. The one thing we certainly appreciate, and that is, if it's good enough for the central banks, then it should be good enough for us. For those who are celebrating today, happy Thanksgiving. We hope you have found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe as a free member for regular email updates and offers. Our Facebook page, which is updated daily, can be found at facebook.com/illuminatisilver. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.